I am super excited to welcome a very special guest, a celebrity, Rick Sharga. Rick is the founder of CJ Patrick Company, a consulting firm that works with real estate companies, financial services, lenders, and tech companies. Rick has previously worked at ATTOM, Realty Data, Carrington and Ten-X. He has been quoted extensively in the press on foreclosure, mortgage, and real estate trends, and appeared on NBC Nightly News, CNN, CBS, ABC World News, and NPR. So Rick was twice included in the Inman News Inman 100, an annual list for the most influential leaders in real estate, an iconic leader by RIS Media in 2023, which is pretty recent. Rick, welcome to the podcast.
Thanks for having me, Alex. Good to see you again, and lots of interesting things to talk about in today's market.
Yeah, I agree. Just a quick story. Rick and I met about 10 years ago when he was with Realty Data. It's interesting to get Rick's perspective today, as Realty Data was right in the midst of running data analysis and foreclosures for everything that happened after GFC, with all the lag from the GFC in 2008 to 2010, the lag of time when we start seeing bank failures, a lot of foreclosures, and how does that time frame is related to what's going on today. So it's going to be an interesting comparison on prior experience that Rick had to live through to what's going on today. So Rick, let's start with the first question, right? What do you think about economy right now?
Yeah, it's a great question, and it has such a huge impact on everything we do in the mortgage and real estate markets. The general consensus among consumers, interestingly, Alex, is that we're in the midst of a recession, and government officials and economists and analysts are scratching their heads because technically we're not in a recession. The technical definition of a recession that economists use is 2 consecutive quarters of negative GDP growth, and our gross domestic product continues to grow, not at ridiculously high rates, but it continues to grow. I think a lot of that is because we're dealing with a massive amount of government spending, deficit spending that eventually we're going to have to deal with, and we'll have some repercussions. And the other reason I think the economy has been stronger for longer than most people forecast is that consumers have had something of a sugar high. There were $15 trillion in stimulus doled out by the government. Consumers have probably now just about exhausted spending all of that money that was out there. And we probably are due to see the economy slow down a little bit. In fact, there are some storm clouds on the horizon. You and I were talking a little bit before this. Consumer credit card debt is one of the red flags that I look at. Consumer credit card debt exceeded $1 trillion for the first time ever in the third quarter last year. It has not slowed down since. It's probably somewhere in the $1.2 to $1.3 trillion range right now. And that's at a time when, because of what the Federal Reserve has done with Fed funds rates, that the average interest rate on a credit card issued during this period of time is somewhere between 25 and 30%. So you have a record amount of debt with almost record high interest rates. And at some point, that could begin to pose a problem. And it's funny too, 30% interest rates used to be what you get from a loan shark, get you arrested for usury. And now apparently it's okay. And it's the new normal. We're seeing delinquency rates go up on credit cards, on consumer loans, on auto loans. We're not seeing it really in a meaningful way in mortgages yet. But we are seeing it in just about every other consumer category. We're probably going to start seeing it in student loans now that it's time for those loans to start getting paid back after being deferred for years.
What you're saying is that homeowners are struggling. There's a liquidity crunch for the average consumer. Homeowners are sitting on the low interest mortgages with pretty much no chance to refinance. Credit card delinquency is up. Student loan delinquency is up. Homeowners are looking to get the cash somewhere to stay afloat. Just in time, Freddie Mac launched the new closed-end second securitization program to loosen up loan origination for homeowners with the first lien with Freddie Mac. In my mind, it's like giving an addict more drugs to survive the day. What do you think?
It's a possibility. What you just laid out is a definite possibility, and I don't think Freddie Mac is looking to securitize HELOCs or home equity loans specifically to do that, but it could be an unintended consequence. What's interesting, Alex, is we've actually seen the number of home equity lines of credit, HELOCs, go down quarter over quarter for the last 3 or 4 quarters. And the reason I say that's unusual is because we have a record amount of homeowner equity out there, about $32 trillion in homeowner equity. So you would think, given past behavior, that more consumers would have tapped into that equity by now to use it for a variety of different things. But we're just really not seeing as much consumer activity there as we might have previously seen. I think partly it's because the lenders aren't pushing the product as much as they did leading up to the Great Recession. And maybe partly because some of the consumers who lived through that Great Recession, the Great Financial Crisis, saw what happened when their neighbors used their homes as an ATM and ultimately lost them to foreclosure. The one area that I know you're interested in that equity is playing a definite role in is the relatively low rate of foreclosure activity that we're seeing across the country. If you look at foreclosure starts, the first legal notice somebody gets in foreclosure, they're at about 80% of where we were back in 2019 before COVID hit. But then if you look at the percentage of homes getting to that foreclosure sale, the auction, they're only running at about 50% of where we were prior to the pandemic. And if you look at the number of bank-owned or repossessed homes, we're down at about 30%. So what we're seeing is homeowners are protecting their equity by selling their properties after they get that first foreclosure notice or even after they get a delinquency notice, rather than risk losing all that equity at a foreclosure auction. And that keeps the overall level of foreclosure activity fairly low. We're also seeing some new programs, equity sharing programs and the like, that people are able to tap that equity to get themselves out of short-term trouble. But, overall, again, one of the things that mortgage bankers reminds us of regularly is that there's a very strong correlation between unemployment rates and mortgage delinquency rates. And right now, unemployment's running at about 3.9%, and mortgage delinquencies are running at about 3.88%. You can't get a much stronger correlation than that. So until we see unemployment numbers go up a bit, very likely we're not going to see mortgage delinquencies go up too much. And as long as those delinquencies stay relatively low, there's just not that many homes likely to be going into foreclosure.
Rick, to add to your point, I think foreclosure starts were low largely because of the servicer incentives to keep the borrower in their home. Post-pandemic, we were giving out enormous amount of stimulus, as well as forcing servicers to do everything possible to keep the borrower in their home by well-designed loss mitigation waterfall approach offered by GSEs for struggling homeowners. With COVID money running out from the consumers, and actually I think they ran out already, we should start seeing higher foreclosure starts towards the end of the year. What do you think?
No, I think 2 things are true, Alex. One is you don't get into that loss mitigation waterfall or process until you're delinquent. And the truth is, because of the strength of the economy, because lenders took most of the risk out of issuing loans after the Great Financial Crisis, the loan quality has been extraordinarily strong. And so we have very low delinquency rates. What comes into play that you're talking about is right after that delinquency happens. So people are always going to go delinquent. They lose a job, they lose income, there's a death in the family, a medical condition, a divorce. There are always reasons that people miss payments on their loans. Increasingly in today's market, 2 things that nobody thought about previously, we're seeing people miss payments because their insurance premiums have doubled. And that's happened in states like Florida and California. It's becoming an issue in Texas. And I've talked to servicers who said people who've never missed a mortgage payment suddenly miss a payment. They go 30 days delinquent. When they talk to the borrower, they find out that they got their annual insurance bill. They hadn't budgeted for it. They didn't have enough cash to pay that and the mortgage that month. So they made the decision to pay their insurance bill that month and figured they catch up on the mortgage. We're seeing the same thing with property taxes, people getting surprised at huge increases in property taxes. So a lot of stress on those borrowers. But what you're talking about with these loss mitigation programs is absolutely true. We've seen extraordinary measures put in place by the FHFA with its partial claims program, by Ginnie Mae, which has allowed servicers to extend terms of loans to 40 years instead of 30 so they can get the monthly payment down. Fannie and Freddie have been instructed by the FHFA to put in place forbearance programs similar to what the government put in place with the CARES Act during the COVID pandemic. So we're seeing a lot of extraordinary efforts on the part of the servicers to keep people out of foreclosure once they've gone delinquent. And then you layer on top of that the fact that a lot of people have an enormous amount of equity in play. In fact, 90% of borrowers in foreclosure actually have positive equity in their homes. So equity can't keep you out of going into foreclosure, but it can give you better alternatives for a soft landing as a borrower once you find yourself in that situation. So the servicers are bending over backwards to avoid putting people into foreclosure. At some point, a friend of mine refers to it as the wash, rinse, spin, repeat cycle. People getting 2, 3, 4 bites at loss mitigation programs. At some point, a lot of those borrowers wind up ultimately defaulting, and there's just nothing left for them in terms of loss mitigation. But let's keep in mind these numbers are relatively small. The only portfolio I'm seeing that is showing significant delinquency rates is the FHA portfolio. They have about a 10% delinquency rate.
Ginnie Mae.
So a lot of the Ginnie Mae portfolio is made up of FHA and VA loans. So there's a direct relationship there. But keep the numbers in perspective. So FHA accounts for about 10% of active mortgages. So that's about 5.3 million loans. 10% of those are delinquents. That's about 530,000. In a normal year, we would have somewhere between 500 and 750,000 loans in foreclosure. Today, we have about 250,000. So if all of those delinquent FHA loans went into foreclosure, it would basically get us back to normal. And the odds are that not all of those loans are going to go into foreclosure, and certainly not all at once. So I see the delinquency side of the market, the distress side of the market, continuing to be much lower than pre-pandemic numbers for at least the next couple of years, unless we experience a severe economic downturn or a recession, in which case the numbers will change pretty dramatically.
Rick, so the
Yes.
huge burden for homeowners is, of course, doubling the real estate taxes and property insurance. And let's not forget auto loan delinquencies and increase in everyday consumer spending. I want to ask you to explain your new consumer inflation matrix, which you call, I believe, Costco Price Index. I actually see a technical recession after this election just because of the higher CPI index and continued 3 to 4% inflation and how it impacts the consumer. What doesn't make sense to me is that if you look at the Fannie Mae and Freddie Mac portfolios, they're relatively clean and the delinquency rates are really low. So shouldn't we see a higher delinquency rates?
Yeah, I think we're already moving in that direction, Alex, to be absolutely honest with you. I mentioned one red flag earlier, which was the enormous amount of consumer credit card debt. I didn't mention the fact that there's about $1.6 trillion in auto loans. There's about $1.5 trillion in student loans. So there's a lot of debt out there, and none of it is particularly cheap debt from a consumer perspective. A couple other red flags. Personal savings rates, which went to an all-time high when the government sent out the stimulus checks, now almost at an all-time low, just barely off the all-time low. So the concern there is whether people are having a hard time making ends meet, particularly people kind of below the median line when it comes to household income, and are tapping into their credit cards to make ends meet, or are tapping into their personal savings to make ends meet, or worse, maybe doing both just to make ends meet. We've seen that movie play out before. It doesn't have a particularly happy ending. The fact that we have very low mortgage delinquency rates suggests that perhaps more of that consumer pressure is on the renter market than on the homeowner market, at least for the time being. That may not continue to hold true. But you can see a scenario going forward where people run out of their credit, run out of their savings. In fact, there's some research that suggests on average, a U.S. household has more credit card debt than they have savings, which is a bad ratio. And we could see things start to get kind of ugly on the consumer side. The other red flag, and this, it drives me crazy when I hear government officials express surprise about this. Consumer sentiment has been terrible. So we've always seen consumer spending and consumer sentiment run hand in hand. I mean, for decades, if consumer sentiment was strong, consumer spending would be strong. And since the pandemic, they've disconnected completely. So consumer spending continues to go up, and consumer confidence is actually tracking down. We had a huge drop month over month recently, about a 10-point drop, which is very meaningful statistically speaking. And government officials are pondering and wondering why consumers are so negative and so pessimistic. The reason this is an issue, Alex, is because 70%, almost 70% of the GDP, 70% of the economy is consumer spending. So if consumers get negative and start to pull back, we could see the whole economy start to crumble around them. And it wouldn't be a huge surprise. But you mentioned inflation, the CPI, and so the economists and the government are saying consumers are unnecessarily negative. It must be the media's fault, must be social media, because inflation's coming down. It's around 4% now. It's around 3.5%. We don't understand why consumers are negative, and they're negative because the cost of living has not come down. I don't like the government CPI, so I created my own, the Costco Price Index. And I remind people that salmon that I bought at Costco a year ago was $9.99 a pound. And today, salmon at Costco is $12.99 a pound. That's not a 3% increase. That's a 30% increase. The cost of gas is up 30% over the last few years. So those kind of things that are very real, very meaningful to the average household. I mean, I look at those things and I'm blessed, I'm lucky. They're an annoyance, but I can still afford them. You know, there are probably some people shopping at Costco right now who are thinking, I can't afford the salmon this week. I have to do something else for my family to be able to eat. And that's the real world that consumers are dealing with. And if we don't see those things start to improve a bit, I would not be at all surprised if consumers do start to pull back pretty dramatically.
Rick, I love your Costco Price Index, which would really show that the consumer spending is down, most of which was driven by a sugar high of pandemic, with government's programs giving money away to the consumer. Wages are flat, and they don't keep up with the inflation. In my three companies, I had to adjust the wages in 2021 just to stay up with the inflation from 2020 to 2021. Renters cannot afford to buy a home, and many young folks are still staying with their parents. I just saw a graph from MBA that it's much cheaper to rent instead of buy. So what's next for the consumer?
Well, at the risk of being extremely boring, usually the answer to these problems is time. If we see wages continue to go up at 4 or 5% year over year, we get the rate of inflation down closer to the Fed's 2% target, over a period of a few years, things will start to feel a little bit better. But we're also in kind of an instant gratification society, so people are always going to be clamoring for things to get fixed right away. And, layered on top of this, Alex, is the fact that housing costs, to kind of get back to our core market here, accelerated the way they did during the pandemic. You saw home prices really over a several year period go up, depending on where you were in the country, somewhere between 25 and 45%. If you were in Boise, they went up 47% in 1 year. And so that living cost, the fact that the asking rent prices in 2022 peaked at about 15% year over year increases. It gets to that point where your basic cost of just being able to put a roof over your family's head was about all people could manage. Those costs are still going up, but they've slowed down significantly. Rent rates in a lot of the country right now are flat, in some cases even negative. Home prices are still going up in terms of sales, but at a much, much slower pace. And the only reason they're still going up is because there's nothing available to buy on the market for the people that are forming households. So it's a tough time to be a consumer, probably a tough time to be a politician who has to answer to those consumers. November should be really interesting, however it goes. And I don't know that, whoever winds up in the White House or controlling Congress is going to have that magic solution to the economic challenges that we're facing.
I agree. I think it doesn't matter who is at the White House in November, Biden or Trump. They'll have a huge mess on their hands past November with a huge deficit clouds over our heads. And if you create more stimulus, inflation will spike. If you don't inject monetary stimulus, that I think we would see a deep recession with the foreclosures and high unemployment.
Well, look, the fact is we have economic cycles, and the economy is not always going to grow. We're probably overdue for a recession at this point. We had a very deep but very short recession during COVID when the government basically shut everything down. And the recovery was just remarkable. If you look at the Great Recession, unemployment peaked at about 12%, but it took a decade to recover all those jobs. In this most recent cycle, unemployment went to about 15% nationally, but we recovered all those jobs in less than 2 years. It's just been an unprecedented kind of drop off and recovery. The extreme measures that the Federal Reserve took, going to that zero interest rate policy for as long as it did, which dropped mortgage rates, which accelerated home purchases, which accelerated home prices, and then to have to slam on the brakes and raise the Fed funds rate as high as they did, which now makes it virtually impossible for a lot of those people to sell a house because they can't afford to buy a new one with an interest rate that's double. It's kind of a whiplash. And I don't know that we've seen this particular kind of pattern in the history of the country. But it would not surprise me if we don't have a recession that we at least start to see the economy pretty dramatically slow down over the second half of this year. The cynic in me believes we probably won't have a recession this year because it's an election year. And we very seldom see that happen, but an economic slowdown would not be a huge surprise.
Rick, I recorded a podcast video at the end of last year where I said that I don't see any rate cuts in 2024. As you know, Street bet on 6 rate cuts in January, 4 rate cuts in March, 2 rate cuts in April, and now it seems that one rate cut is the consensus. I still don't see any rate cuts until 2025. What is your current view?
I would not put any money down to bet against you, Alex, on that one. I always thought the notion of rate cuts starting in March was crazy. I never expected to see that. And if you look at things historically, we might have expected to see a rate cut in June or July, just based on normal patterns. But the fact that inflation ticked up for a couple of reports tells me they're not going to be in any hurry to do a Fed fund rate cut. They might throw one in toward the end of the year. And I'm kind of hopeful that they do from a mortgage and housing perspective, because I don't expect to see mortgage rates come down meaningfully until we get that first Fed funds rate cut. And if that's the case, that we don't get a cut this year, that means mortgage rates probably stay in the 7s for the rest of the year, which means both existing and new home sales are going to stay slow, which is a drag on the economy.
Yesterday, I found out that I have a new podcast listener, my mother-in-law. She commented on prior videos that I did with many other guest participants and shared with me her experience that she tried to get the second mortgage from a few lenders, and the interest rate she was getting was around 9.5%, 10%, which is quite large. So her decision was to wait it out before tapping into the equity of her home to get much lower interest rates towards the end of the year or in the first quarter of 2024. I think there's many folks that are in the same boat with as my mother-in-law, in sort of a wait-and-see mode that, what happens with the treasuries and the interest rates.
And then we'll have to deal with what bond yields are, because as you know, 30-year fixed rate loan rates tend to go in correlation with yields on the 10-year U.S. Treasury. And the Treasury markets are still sensing trouble in the waters. We're seeing yields pretty high and those rates pretty high. And that's probably because of concerns about deficit spending. So even if the Fed starts to move the Fed funds rate down, it's not a guarantee that the bond market is going to play along. So, who knows how that all plays out. Excuse me. The other factor, and, forgetting about your mother-in-law for a second, the other factor that plays into this is commercial investment. And commercial loan rates are, double or triple what they were during those periods when the Fed was keeping rates low. So if you're a fix and flip investor, if you're looking to buy a property with a bridge loan that you can rent out, put tenants in, you're looking at rates. If you're really, really lucky, you might be in the high nines, but not unusual at all to see rates 10, 11, 12% on those purchases. And that keeps investor activity lower. And that's not even getting into the big commercial market area where we have, some potential carnage in the office sector to look forward to. So, there are a lot of headwinds facing the economy right now, and real estate, unfortunately, looks like it might be one of them.
So let's switch gears to commercial space and banking sector. Let's look at the time before Fed started to raise the interest rates. I was in the same boat as many banks out there by hedging strategies using 3 to 4% interest bonds, right? With the fast rise of the interest rates, the bond prices collapsed by 40 to 50%. And those banks are now in trouble because they never recovered. Fed Chair Powell stated that 200 to 300 banks are in danger of failure. Now, FDIC took over SVB and Signature Bank with the fresh bank failures this year, which is being Republic Financial. At the same time, Bank of America, Citi, and Wells, as well as JP Morgan and Chase, all replenishing the FDIC fund to take over more banks that are in trouble, that in essence failed and currently zombie banks. So why don't we see more bank failures this year?
I think we're going to see some fallout in the banking sector. I don't think it's going to be quite as bad as the headlines have been suggesting over the last year. I think there was a little bit of a shock value in the high-profile banks that went south when they went south last year. But if you kind of dig through the data, what you find is, bad investment decisions, and those can be papered over if the market continues to grow. But when the market slows down and you're sitting there, and as you pointed out, maybe made the wrong bet on your hedging strategy, and now you have to go mark to market, and everything you have is underwater. That creates some issues. I think the commercial market is more nuanced than people really acknowledge. If you're in the industrial sector of commercial, it's as strong as it's ever been, probably outperforming. Warehouse distribution centers, cloud computing centers, cannabis facilities, lots and lots of different opportunities, and the industrial sector is doing pretty well. The retail sector is doing surprisingly well. Malls are still struggling a bit, but if you look at the other kind of retail operations, they're all actually doing pretty well. even the hotel sector isn't doing as badly as I expected coming out of the pandemic. There's been a little bit of a fall off there, but generally it's kind of holding steady. So that leaves the two biggest sectors, multifamily and office. And there's about $600 billion in mortgage-backed securities coming due to reset this year. I say about because there were probably $100 billion worth of mortgage-backed securities that were supposed to reset last year that got pushed into this year. So I'm not sure exactly what the real number is at the moment. I think you'll see a little bit of damage on the multifamily side, but demographically, it looks like we have a pretty good tailwind for the multifamily market. So there are some syndicators who probably over-leveraged and won't be able to refinance at today's rates in a way that makes sense. So you'll probably see a little bit of a fall off there. But over the next year or so, I think multifamily kind of settles in and has a little bit of damage, but isn't terrible. On the other hand, the office market is a mess, and it's particularly a mess in the central business districts of big metropolitan areas. So San Francisco, Los Angeles, New York, Chicago, Seattle, even Miami, surprisingly, considering how well the rest of the state is doing. High vacancy rates, property values plummeting, and it's just a mess. The reason it might not be as bad for the banks as you think is because those regional, local community banks tend not to have the notes on those properties in those central business districts. They tend to be the purview of the insurance companies, of retirement funds, of hedge funds, private equity firms, institutional investors. But somebody's going to be holding the bag for properties that are now selling for 25% of what they sold for last time. And there's definitely going to be some chaos going on in those markets. But if you look out at where the community banks and the regional banks really hold the notes, those secondary, tertiary markets, the suburban markets, there's some fall off there, but it's not nearly as bad as what we've seen in the major metropolitan areas. So I don't think we see massive numbers of bank failures. But I did see a presentation by the chief economist at CBRE. He said his team analyzed records from all 4,000 banks across the country. They saw about 300-ish that were probably vulnerable because of their commercial holdings. Didn't mean that 300 were going to fail, but those are the ones to keep an eye on. And we'll see how it all plays out. But the commercial market is, from a real estate perspective, is seeing a lot more trouble than the residential market for sure. Or time will come back to bite us in the office sector. So I don't think, let me do that again. I think the office sector caught COVID a little bit later than other sectors of the market and is recovering more slowly. The fact is, a lot of the carnage that we're going to see in the office sector was covered up by long-term leases and by the ability of some companies to be able to sublet to get out of their lease obligations. At some point, those all expire, and it'll be interesting to see if the building owners are able to refill those buildings. And you can see a doom loop happening in some cities. We saw it in St. Louis, where because the office sector goes down, the retail sector goes down because those office employees aren't coming into the office anymore. So they're not going to the dry cleaner or the local restaurant or the local store. And you see that kind of progression as the other sectors take a hit as well. So we could see some of that. I don't know how widespread it gets, but I don't think we're out of the woods on the commercial side yet by any means.
To your point, I think the office sector is still in deep trouble with work from home here to stay, and people are not returning to the offices. I do think that we're still not out of the woods yet.
Well, there's a couple things. One is, and again, at the risk of being extremely boring and obvious, follow the money, follow the population trends. We're continuing to see fairly strong population migration away from high-cost, high-tax states. California is still losing hundreds of thousands of people a year. New York's losing 100,000. Illinois is losing around 100,000. Population is moving into the Midwest and the Southeast, and a little bit of the Southwest. And so if I were an investor I would be looking at market opportunities where we're seeing population growth and job growth, and that it tends to be those parts of the country. You're also going to see some distress assets hit the market at what will be probably one-time bargain rates as people default on their loans. According to a recent report from ATTOM data, commercial foreclosure activity is running at about 107% of where it was a year ago. Now, keep the numbers in perspective. We're talking about 700 or so foreclosure actions a month, not tens of thousands. But while residential foreclosure activity is still trending down from pre-pandemic, we're seeing commercial activity go up. And that's across the board. Very, very expensive properties all the way down to low dollar kind of properties. So you need to understand your local market to determine which sectors are vulnerable. But in broad strokes, if I'm an investor, I'm watching where people are moving. I'm watching where jobs are moving, because that's going to create opportunities both for housing investments and for commercial investments as well.
Just to add to what you said, I think there will be a lot of opportunities in bankruptcy. We have the highest number of bankruptcies to date in the past 5 years. I think there will be some real estates sold from the trustee sales of bankruptcy, and some certainly investor opportunities.
Last year, for the first time in about 5 years, bankruptcy filings increased in all categories of bankruptcy. And interesting, you talk about real estate falling out. So I think that's probably most true on the commercial side. On the residential side, declaring bankruptcy actually forestalls foreclosures. It doesn't terminate the foreclosure, but it drags it out significantly. So at some point, there might be a property coming out of a residential bankruptcy that becomes available at something of a discount. But in the shorter term, I'd be keeping an eye more on commercial bankruptcy filings to see if there might not be some opportunities for investing in those kind of facilities.
One more areas of opportunity is HECM's vacant property sale, right? I think HUD used to sell one sale of vacant property HECMs a quarter, and now it's almost every month, where we see a lot of the buildup of the inventory, and more investors are now looking at HECMs as a potential venue for investment.
Actually, we've seen that's the one area of residential foreclosure activity I've seen growth in. We've seen more HECM foreclosures than we've seen in prior cycles, and more foreclosures where the borrower is deceased. In fact, Florida just put a law in place requiring a servicer to open an estate to go through probate if they're going to foreclose on a deceased borrower, even if the family hasn't opted to do that. Just bizarre times. But yeah, I mean, we did have a higher incidence of elderly deaths coming out of COVID. And some of those loans have kind of gone through their cycles now and are coming into the foreclosure market. But yeah, you're in today's market, because of the lack of inventory pretty much across the board. You really do have to be opportunistic, and it requires a lot more diligence, a lot more homework to be able to find those bargains, whether it's residential or commercial, than it has in the past.
Rick, what's your opinion on overall housing market, lack of inventory, builders' states of affairs? It looks like it's very state-specific. I'm curious about your opinion on sort of macro view of what we see in the housing market.
Yeah, if I'm looking at the overall housing market right now, I've had to kind of pull back from my original forecast for the year. I really did believe coming out of last year that we had bottomed out in terms of home sales. It was the lowest number of homes we sold in 25 years. But every month so far this year through April, we've actually sold fewer homes than we sold a year ago, which effectively means we're in the middle of the spring selling season and lagging behind 2023's numbers. So I'm now expecting that we probably wind up selling right around 4 million units this year of existing homes. New home sales will probably be relatively strong just because they're available, because builders are continuing to offer concessions and even buy down mortgage rates to make those properties more affordable. But it's going to be a sluggish year for home sales this year, and probably into next year until we see mortgage rates come down low enough that homeowners can afford to put their properties on the market.
Rick, are you projecting the recession at the end of this year?
I still don't think we're in a recession by the end of the year, but I do expect to see the economy slow
Listen,
down.
I wanted to thank Rick Sharga, this celebrity, for coming into my podcast and discussing some of the key indicators of the housing market. If you don't know Rick, or if you don't know where to find Rick, find him on LinkedIn. He posts at least twice a week very important videos on his opinion on what's going on in the housing industry. We're very lucky to have Rick here, and I'm hoping to meet Rick at the upcoming conferences that we both attend, and then we can bring Rick at the end of the year to just see whether our predictions were correct looking towards Q4 of 2024. Again, thanks again, Rick, and see you next time.
Thanks for having me, and we'll definitely catch up toward the end of the year.